So I was asked to talk about what next for capital markets and really how to position your portfolio. And I sat down and I thought about, what have we been witnessing over the course of 2025? And how do I think that's going to impact markets and returns in 2026? And three words really came to mind: disparity, dispersion, and divergence. And so, let's unpack that a little bit. What are the things we've been witnessing over the course of 2025 that we think will be very important to consider as we build portfolios for 2026? So the first thing is around inflation. So, we have seen inflation come down, but it's still well above central bank targets in many countries around the world. And so there's going to continue to be a trade off between an inflation and growth as we look out over the course of the next 12 months. This concept of conflicting economic shocks that are jolting the global economy. If you think about it, we've been through a period where we're seeing, positive fiscal stimulus, a modest easing in monetary policy, but also tariffs, protectionism, and booms from capex in AI spending. We're also seeing a more politicized policy responses. And, in a rising backdrop of wealth inequality, of populism, I think what we're going to see is central banks, having a greater willingness to stimulate quicker and slower to tighten monetary policy. Finally, the two things that I think are quite interesting, that are positive for equity markets as well, is the earnings growth backdrop, which is continuing to see greater breadth, but also the impact of AI and the bifurcation that's perceived in AI winners versus losers. And so, how do you build portfolios in this environment? It's our view right now that you want to have resilience in your portfolio. You want to have more than one bet. You don't want to just be bolted to the beta of technology, for example. You want to focus on companies that have low economic sensitivity and consistent earnings. You also want to think about differentiated returns, uncorrelated returns. And so thinking about a wider range of businesses that can perform in a wider range of economic environments, that have insulation from geopolitical concerns, from tariffs, from inflationary pressures, and thinking about sort of this concept of global diversification. So in this heightened level of economic uncertainty and uneven growth, there's going to be dispersion between countries and industries. And so building a portfolio that is potentially more outside the US under this new regime could be very useful. Now, let's talk a little bit about what I mean by this new regime. And I want to contrast history versus what we're seeing right now and today in markets. If you think about it, for the last 20 to 30 years, we've been in environments of low inflation and modest growth. Very good for risk assets. We've had accommodative policy, partially driven by the fact that inflation has been very low, below 3% and close to 2%. So central banks have been able to be stimulative and supportive when we've seen economic shocks. Globalization. We've been in a period of 20 plus years where companies around the world have looked for the lowest cost of production. And they've looked externally to think about their supply chains, think about their manufacturing, and that is also reversing. Suppressed macro volatility. We've had coordination from central banks, lower geopolitical tension, and that's been very supportive for easing of macro volatility. And finally, ample market liquidity. In an environment of low interest rates, the cost of capital has been low, but also access to capital has been low. All of those are reversing as we look out over the coming years. Structurally higher inflation, more restrictive monetary policy because of the challenges between growth and inflation trade-off, deglobalization. So governments and countries around the world are far more focused on energy security, supply chain security, and ensuring that their spheres of influence are closer to home. Increased macro volatility. We all saw that in 2025 with Liberation Day, tariffs, and geopolitical tensions that we've just seen, spark up, especially over the last week with Venezuela, and less plentiful liquidity. The cost of capital is higher today. Interest rates are higher, and so you have to be far more prudent in how you allocate capital because it costs you more. And so to bring this to life, I really wanted to give you, an illustration of what this means in terms of the economic regime that we have been in to potentially where we're going. And so what I did was I looked at how we've performed in terms of economic regime for the last, I call it 30 years, and then the prior, effectively 30 years. And so what you see on the screen here is that we've been in Goldilocks environment. So low inflation, modest growth, 75% of the time for the last 30 years. It's been a phenomenal environment for risk assets. As we look out over the coming decade, that looks like it's going to change meaningfully because of those factors, the new regime that we're in. And so there's going to be a greater volatility in inflation, potentially disinflation, but also recessionary, and sort of an environment where you potentially have high inflation and recession, so stagflation type of environment. This is all means that when you're building a portfolio, you have to be very conscious about which asset classes you have and having a level of resilience and diversification. So just to bring this to life, I thought I would bring you through a couple of charts that really talk to disparity, dispersion, and divergence. So the first one is really, somewhat positive, but also, I think quite helpful to thinking about the future. And so if I think about, inflation, we have come down significantly from where we were in 2022. The light blue line shows you that. But the level of stickiness in inflation has continued to be relatively high, and you see that in the black line next to it. And that continues as we look out over the course of 26. Also, what we're seeing is disparity in central banks' ability to respond to the economic environment and big divergence between different central banks around the world. And so we're not seeing that same level of coordination. Japan and Europe are probably the two most extreme examples where Japanese governments and central banks are increasing interest rates while the rest of the developed world are in the midst of thinking either of being on hold or lowering rates potentially further. Disparity in terms of what we're seeing in input prices and manufacturing. So right now we're seeing a drop off in things like new orders, unemployment modestly picking up, but actually the prices of widgets that are going into goods that are being manufactured ticking up, and that's a reflection of tariffs, of trade, and those implications flowing through to the economy. The other piece is volatility. And what you'll see is we're seeing greater dispersion in terms of volatility over different time periods. So this is just the volatility index. But what you'll see is we've seen more spikes in the recent past than we have had in history. And we believe that, as we look forward, investors, portfolio managers are going to be far more focused on shorter term earnings, on cash flows, and they're going to be highly data dependent. And so again, building resilience into your portfolio, being thoughtful about where you're allocating capital in a higher volatility environment is going to be very important. We're also going to see volatility and dispersion driven by policy. And I think we saw a heavy level of that in 2026. What you see is the highest point on this chart was Liberation Day. We've come down fairly considerably from there, about half the way back to sort of normalized levels, but still at an elevated pace. And so what I would say is, as I look out over the course of 2026, this is an environment where economic policy, trade policy is going to continue to be a big impact on headlines, on companies' earnings and their ability to navigate markets. We're seeing divergence in equity market performance. If I think about US equities in particular, they've been driven by growth stocks, by technology, by artificial intelligence. What's interesting is when you dissect global equity returns and you look outside of the US, you'll find that areas like Japan, like Europe, value as a factor has outperformed considerably over growth. And so as we look forward, we do believe that there is some secular tailwinds in a number of these markets where fiscal, monetary policy, as well as underlying corporate earnings are improving. And so looking outside the US could be quite interesting, but having a differentiated portfolio of different factors, growth in the US and value outside the US, could be beneficial. The other piece to look outside of the US in terms of building diversification in your portfolios is thinking about what's going to happen to the US dollar. And again, I think we're seeing divergence in currency performance. In 2025, we saw a meaningful, basically, depreciation in the US dollar versus a basket of major currencies. And as we look out over 2026, we believe that that's going to continue to persist. And so looking at international equities could add an added value from having that currency component. The other piece is disparity in terms of the makeup of the index, but also outsized winners from a very small part of indices. And so what I've shown you here is the S&P 500 and the concentration you have in the largest 5 stocks. Those stocks today make up 25% of the index. So just by buying the S&P 500, you've already made a decision, an asset allocation call. And so, I urge investors to really think about what does their portfolio look like, and do they genuinely have diversification when they're buying indices? And the other piece as well is that over time, we tend to see innovation and creative destruction that creates divergence and dispersion. And so I went back and I looked at what were the largest companies in the MSCI All Country World back in 2000. And what you see is a number of these companies don't exist anymore or are a fraction of their size. Nokia. Who has a Nokia phone in this room anymore? None of us. NTT, shadow of itself, doesn't exist. Intel, much smaller company. Nvidia, Broadcom, these are the largest companies in the index today. And so my key point is there that innovation disruption is continually happening. And so by just buying an index, you have to appreciate that you have made a decision, and innovation is going to change those constituents. And so as we look forward, you have to really think about sort of where are the earnings coming from, and which are the best companies that aren't going to win just today, but for the next decade. So, thinking about earnings growth, this is really interesting. This is where we're seeing very strong positive signs. So in the US, you're seeing the EPS growth continue to outstrip sales growth, seeing very positive momentum in earnings. But what's more important, I think what's really, thoughtful to appreciate is how are value stocks doing and how are stocks outside of the S&P 500 doing? And so what you're seeing is actually there's now a widening in earnings growth and more consistent earnings growth outside of the mega cap companies. So if you look at the Russell 2000 and the S&P 600, from mid-June 2025, you've seen a sharp uptick in earnings growth and positive momentum in earnings. And so that shows you there's a widening, a broadening of equity market performance. And so, in that type of environment, actually a wider range of stocks can perform well. And that's not only in the US, we're seeing that phenomenon, but we're seeing that phenomenon globally. The other piece to really think about is where to here for AI. And, what we saw in 2025 was a clear bifurcation of AI winners and AI losers. And so, when we think about portfolios, what one interesting thing is think about what is the secondary impact? What are the next gen winners of artificial intelligence? Which companies are actually leveraging artificial intelligence across industries to create more productivity, more efficiency, and generate higher profit margins and earnings growth? The piece here shows you at the bottom is productivity. We haven't actually seen the rubber hit the road in terms of AI driving productivity yet. And so I do think we have to be very cautious about where we're allocating capital in this space. So how should you think about portfolios? The first piece I want to think about is, again, just this concept of investing in companies that have a level of resilience, companies that have low economic sensitivity and consistent earnings. In this environment of disparity, dispersion, divergence, you want to own businesses that can perform irrespective of what happens in the broader economy and what happens between different countries from a geopolitical perspective. Introducing differentiated returns, returns that aren't correlated to a single sector. So building exposures that have a wider range of businesses that can perform over a wider environment. So, I think a lot of people probably own tech portfolios, growth portfolios. How do you introduce uncorrelated returns alongside that? And then finally, having a global mindset. Uneven economic growth, dispersion really creates a wide set of opportunities to identify businesses that can perform irrespective of what's happening in the US. So to bring this to life, this concept of resilience, we use the term durable. And so in our philosophy is to identify businesses that have very durable business models. And funnily enough, these are businesses that we interact with every day. So I use the analogy like, what do we all do every day? We go to work, we come home, we make dinner for our family, feed our kids, put them to bed, and we take out the garbage. And so you see in the top left corner, garbage trucks, waste management. Irrespective of what happens between China and the US, Russia and Ukraine, we all need to take out our garbage. And so if we can find businesses like that are growing, compounding at 10% per annum, these are really interesting companies that have nothing to do with geopolitics, with the broader impacts of the economic cycle, inflation. Look a little bit further around the screen. Cell towers. We all need to send text messages. We all need to communicate with our wives, with our kids. We all need energy. We all need power. We all need to keep the food in our fridge cold and the lights in our houses on. We all need access to healthcare. We all need to insure our cars and our homes. These are the types of businesses that we believe exhibit those two key characteristics: low economic sensitivity and consistent earnings. And if we can find businesses like that and put them in a portfolio together, we believe we can deliver outsized returns that are uncorrelated, differentiated, and help diversify your overall portfolio. The other piece that I think you really need to think about as you're building portfolios is insulation. So, insulation from trade, insulation from geopolitics. And so, what we've tried to do is identify businesses, and we call a lot of our companies local for local. And that's really the view that if you find a business that he's getting its inputs locally, is manufacturing locally and selling locally, you're basically removing a lot of those trade barriers, those global implications. And so, again, a waste management company that's operating across North America is local for local. Global diversification of supply chains, global businesses that have manufacturing, have their customers close to them where they have their manufacturing and import service sources. So you could have a can manufacturer that has facilities in the United States, in Asia, and Europe. And so again, you're minimizing those impacts from having to bring materials across borders. And so again, building resilience and having localized operations allows you to have a collection of companies that can really perform irrespective of the broader environment. The other piece to think about is, how is AI going to change the nature of how we work, how we live, how we play? And so, as we look at these companies, we're very conscious also to think about evaluating and having a screen to identify which companies are actually leaning into AI and leveraging it to generate greater productivity, greater resilience. And so, we've identified, asset managers, healthcare companies, insurers, capital markets businesses that are leaning into artificial intelligence. And financial advice is actually probably one of the greatest areas that can benefit from it. When you can automate a statement of advice, when you can leverage artificial intelligence to help you with your business operations, you have more time to focus on engaging with your clients and being more effective. but there's also AI losers. And so we're very conscious to look for, to avoid companies that potentially at the surface look durable, have consistent earnings, but really can be disrupted. And two of those areas right now we're seeing it is in advertising agencies and IT services. So with that, my key takeaway really here is again just to think about building portfolios that can benefit from disparity, dispersion, and divergence, and really having resilience in your portfolio. So with that, I would say thank you very much for your time, and I look forward to taking questions on the panel.